Welcome back. Well, as we read through the economic reports on a weekly basis, this gives us a good gauge as far as where the economy is. But what we want to do is take a historical look at some of the more significant numbers that are reported so we can get a better idea, a better context of where we are within the economy. And the benefit is maybe we can get a better idea of what's to come. So the first number we're looking at is the Consumer Price Index, the CPI. This is in the year 2000 through 2002. It's a measure of inflation. 3.7% inflation was reported June of 2000. That through the dot-com bubble went down to levels of 1.1%. So that was a pretty big drop in inflation. Core CPI, which excludes food and energy, the more volatile components of inflation, started out around 2.5% and ended this period around 2.5% as well. What we're going to see is that the numbers during the 2001 2002 recession were not as volatile. It was a dot-com bubble, and certainly it hurt for the stocks to go down, but it was actually not very widespread in terms of the economics. The CPI food only sector, 2.3% went up to actually 2.6. Food got a little bit more expensive during that period of time. CPI energy went from levels of up 21.3% on a year-over-year basis to negative 15.4 on a year-over-year basis. So you can see the energy sector was really, in terms of inflation, the most volatile component during this period of time. Now compare that to 2007 through '09. CPI, the standard number we talk about, 2.7, went down to flat by the beginning of 2009. CPI excluding food and energy 2.2 down to 1.8. It hardly moved. Food 4% up to 4.8. Food got a little bit more expensive during that period of time. Energy 5% down to negative 20%. So 2001 and 2008 are very similar in the sense that energy was very volatile and really went down the most in terms of inflation that we measure. Present day, we take a look at March of last year, 8.5% CPI, a huge amount of inflation. That's currently 3.2. It's still above the Fed's 2% target, by the way. CPI, core CPI, excluding food and energy, 6.5 down to current 4%. Food only 8.8, actually hitting levels of 11.3 in August of last year, down to 3.3. Food's gotten cheaper. Energy, the most volatile component, just like in prior economies. 41.3% reported in June of last year. It's negative 4.5% on a year-over-year basis. It seems that in terms of energy, we are actually ahead of the curve. We're moving faster to the downside than we have in the past, at least in terms of energy. Left-hand side of the chart shows a CPI, the standard number year over year, topping out around 5.5% in mid '08, then hitting a bottom early '09, back to the upside since then. CPI on the right-hand side, topping out at over 9% around mid last year, the beginning of the inverted bond market, currently 3.2%, still above the 2% target that the Fed maintains. Taking a look at inventories. Now, this is a different type of report. We want to see low numbers. The inventories represent what stays on the shelves and manufacturers and wholesalers that the consumers are not buying. A higher number is not good. And we can see in the year 2000, where did the inventories really rise? Well, petroleum from negative 2% up to 13%. Motor vehicle parts, 2% up to 8%. We see here, let's see, apparel, 6% up to 8%. Not a big mover, actually. So there are two real big movers in terms of inventories. What the consumers are not buying by the end of the year 2000, petroleum, motor vehicle parts, kind of one in the same sector almost. 2008, what moved a lot? Well, we hit a low of negative 6% inventories in petroleum the beginning of 2007. That went up to 35% by February of '08. Huge run up in inventories in petroleum, motor vehicle parts. That wasn't affected as much, not like the year 2000. Take a look at inventories in terms of Farm products down from -2% up to 73% in terms of farm products, and that's in the year 2008. We take a look at beer and wine that went from 8 to 12%, not a big mover. Apparel went from 1 to 5%. So the real big move in terms of 2008, that was farm products. Fast forward to present day, where have the inventories really grown? Well, motor vehicle parts, 8% up to 14%. That's pretty big. Petroleum has actually fallen from up 26%. Now, maybe it's really not so fair because we're comparing prior peaks of inventories to where we are now, which is not the peak. Take a look at how petroleum, the inventories peaked out at 44%, and since then have really fallen to the downside. Take a look at inventories of beer, wine, up 24% and now only 3%. So the fact of the matter is, and I think we're going to see this in some of the other numbers, it looks like we're kind of ahead of the curve where we would have maybe expected the stock market to go down as it did in 2001 or 2008. It seems that the economic numbers are moving ahead, but the market, for some reason or another, just hasn't moved. Take a look at jobs. In the year 2000, we had 132,000 non-farm payroll. Through 2001 and 2, we only dropped down to 130,600. Not a big move down. Take a look at the unemployment rate, 4.1 up to 5.9%. Wasn't awful. The labor force participation rate stayed steady around 66%, give or take. Again, the year 2000, it was not a widespread recession, aside from obviously the tech sector. Now, remember, that was 132,000 non-farm payroll. Now we see May of '08, 137. It dropped down below 130 by early 2010. So definitely non-farm payrolls were hurt worse in '08 than in 2001. Take a look at the unemployment rate. Remember that was at 5.9% in the prior slide? Well, now we see May of '08, 5.4 went up to as high as 10% unemployment rate in the year 2009, October. Labor force participation rate, remember that was in the 66s in 2000. Well, that dropped down to 64.8. Well, 64.8 does not sound good, but compared to present day, right now, we're at 62.7. Remember the prior year 2000, we had 132,000 non-farm payroll. 2008, we had 137,000. Well, now we're at 156. Tell us what you think. Why are the non-farm payrolls so much better now, but the labor force participation rate is so much worse? Remember, in the year 2000, non-farm payrolls were 132. In 2008, they were 137. Now they're 156. Labor force participation rate in the year 2000 was 66. 2008 was 64. Now it's as low as 62.2 late last year. There's a real interesting discussion we can have as far as within the labor market, why certain things are moving the way they are. Why does non-farm payroll look so much better, but labor force participation rate looks so much worse? Here's non-farm payroll 2006 through 11. We peaked out mid or early '08 at 138,000. Well, we saw obviously the COVID crash present day on the right-hand side. That went down to 130,000. But since then, we really have recovered. Very interesting. With the inflation, it really doesn't feel like we're experiencing this recovery, but that's what the chart tells us. How about construction spending? Well, we have data for going back to 2006, and we can see at the time what was the biggest rise, or we should say, let's first take a look at the fall in construction spending. The biggest were obviously the residential numbers. Construction spending residential, 8.8% went down to negative 23.2% December of '07. Now again, we know the 2008 recession was completely centered around housing, real estate, construction. No surprise here. This was really the hardest hit within the economy, construction spending, especially on the residential side. Well, 2023, we can see that construction spending has fallen. Residential, it's negative 2.1%. We did have numbers as low as 14.4 to the downside, negative 14.4. Interesting though, total construction spending looks a little bit weaker. Other areas, office, lodging, really was not looking good. Now down 23, even 27%, mid 22. I think some economists may make the argument that the COVID crisis really kind of took a lot of the wind out of this recession, meaning it got a lot of the work done that the recession is supposed to do. We have recessions to sort of clean the economy and to reset it. And maybe that was the case because notice how the lodging, which was certainly hurt the hardest during the COVID crisis, empty hotel rooms across the country, we're down 27.6%. But since then, we've recovered. But then again, on a year over year basis, anything would look like a recovery after a 27% move to the downside. But certainly the what is troubling today is a residential construction is down in negative territory. And it's been that way for quite a while. Schiller National Home Price Index, 2001 through 2002. We see here 9% all the way through. The 20 city average, 12% to 11%. Now, we've spoken about this in the past. I think the part of the Case-Shiller home price index and the building permits, especially, that is most representative of our economy is the 5 units or more. These are building permits. When you go out there and we're gonna build a new house or an apartment building or something, we have to get the permits. Well, the permits are very much a leading indicator. Notice in the year 2002 building permits down 20%. Notice in the year 2007, building permits, especially for 5 units or more, we're talking about major investment projects. We're talking about a large apartment buildings, condominium complexes. That's most closely correlated with the S&P 500. In 2007, we saw numbers down negative 23%. Also, the total units and the single family units were down equally as well. Well, this is what's really interesting. What's unusual is that currently the 5 units or more. And I think that one of the takeaways from today's discussion is that this seems to be the most negative of all the reports is the 5 units or more. And if you haven't, take a look back. It's maybe about a week ago. We talked about building permits, specifically in the correlation of the S&P 500. The 5 units or more is most closely related to the S&P 500. And currently we're down 28%. There is just very little activity out there for large apartment complexes. And that again is most closely correlated to the S&P 500. Here's a Case-Shiller U.S. National Home Price Index. This is 2002 through '09. The green line is a 20 city composite. They move very closely together, but we talk about both. But notice how we are present day. We're just a little bit above zero. In the prior number, we hit the zero level and then went all the way down to negative 20%. So the Case-Shiller right now, as much as we just spoke about the other day, existing home sales declining at the worst rate since 2013, I believe. But the fact of the matter is, we haven't really experienced what we experienced in the prior 2008 crash, that we were down 20% on Case-Shiller numbers, or negative just by a hair at the moment. But certainly, maybe a lot would argue that we still have a lot of ways to go. Here's building permits, left-hand side, 2006 through 11. We hit these lows November of 2008, down 50% negative territory. Well, the building permits currently are just a little bit below zero, hitting levels of around negative 30%, but we've since recovered. So certainly not to the same depth that we saw the 2008 recession, but still a cause for concern. There's a lot of people out there that may think we still have a lot more pain to go through, so to speak. So to sum up what we're looking at here, and if there's an interest, we're going to continue this discussion with some of our other economic numbers. We have retail sales to talk about. Manufacturing is a lot to talk about as well. But I think some of the big takeaways is that number one, energy seems to be the most volatile component of inflation and other measures as well. That is still coming down, but we had a lot more way to come down because of the inflation battle that we've been battling, that we've been fighting over the past couple of years. In terms of the jobs sector, why is it that non-farm payrolls look so much better, but the labor force participation rate looks so much worse? In terms of housing, specifically case-shield or building permits as well, and construction spending, it looks like we're going through some pain, but historically, it looks like, well, maybe we could be due for a lot more pain in the time to come. Of course, we could take the other side. It's not all, it doesn't have to be all bearish and pessimistic. There could be a light at the end of the tunnel and say, well, maybe we've gone through the worst and that maybe construction wasn't hurt as much as it was in the past. Maybe our housing market's not going to suffer as much as it did in '08. So again, every economy has a slightly different dynamic, and I think it's important to recognize exactly what's moving within the economy, and maybe we can, position ourselves accordingly. As always, we're going to continue to watch these numbers very carefully, and we'll be certainly update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.